Today, inshallah, we are going to continue from where we stopped the last time. Of course, the last time we started with discussing the different methods that we can use in order to allocate the joint costs onto the different joint products or the main product and the byproducts. Therefore, we said that we have two categories of methods. The first is a market-based category, and the second is a physical measure category. And we started with the market-based, with the sales value at the split-off method. And we took an illustration, we took an example. The example said that we processed 110,000 gallons of raw milk, costing, or this joint process cost $400,000. After the split-off point, we would have two different products. Of course, in this case, these are called joint products. The first is the cream. The second is the liquid skim. Of course, the cream was with the quantity of 25,000 gallons, while as the liquid skim was with the quantity of 75,000 gallons. And according to this information and the information given for this example, we were able to allocate the joint costs using the sales value directly after the split-off point. Therefore, we calculated the sales value for the cream after the split-off point, as well as the liquid skim, and then we allocated the cost or the joint cost of $400,000 onto these two different products or two different joint products using the relation or using the percentage of these sales value to the total sales value of the production. Therefore, as we can see here, we attained a gross margin of 20% for the first and 20% for the second. Therefore, of course, using the sales value method at the split-off point, here we achieved by coincidence the same gross margin percentage. We need not to confuse the sales value at the split-off point method with another method that will always attain a fixed percentage or a percentage that will be equal for the different products. Here, it is only a coincidence that we have 20% for each of the two products. Of course, this was what we took in the last time. Now let us use the same example to see how we are going to allocate the joint costs onto the cream and the liquid skim using the physical measure. So, what do you think, or how we are going to use the physical measure? What do you think the basis here in order to allocate our joint costs? As the method says, we are going to use the physical measures. We are going to use the physical attributes. Of course, the physical attributes here for our example or for the cream and the liquid skim is the number of gallons. Excellent. Therefore, we are going to allocate the joint cost of $400,000 onto the cream and onto the liquid skim using the percentage of the gallons of each product from the total gallons of the production. Therefore, as we can see here, step number one, or the first thing that we are going to do, is designate what is the number of gallons for the cream and what is the number of gallons for the liquid skim. Of course, the percentages now are 25,000 from the 100,000 for the first one, or for the product cream. Therefore, 25%, while as the second is 75,000 gallons in relation or in consideration of the 100,000 gallons of the total production. Therefore, the percentage would be 75%. This means that from our production process, 25% of our total production is cream, and 75% of our total production is liquid skim. Therefore, the joint costs would be allocated using these percentages. Therefore, we would multiply the 400,000 by these percentages. Therefore, 100,000 for the cream and 300,000 for the liquid skim. Therefore, of course, the addition of these two numbers would always equal the joint cost of $400,000. After this, we need to calculate the cost per gallon. Therefore, the cost for the cream is 100,000, and we have 25,000 gallons. Therefore, the cost would be $4, as well as here for the liquid skim, $300,000, which is the cost of producing the liquid skim, divided by 75,000 gallons. Therefore, the gallon would cost $4. Now, let us compute or calculate or prepare, let us say, the income statement. Of course, we are going to start with the revenues. As we can see here, we used the total production number of gallons, not the number of gallons that was sold within a specific period. This is an important point to take into consideration when allocating the cost or the joint cost onto the different products. Therefore, in the income statement, first of all, we are going to consider the revenues. We sold 20,000 gallons of the cream by the amount of $8, 30,000 gallons by the amount of $4. Therefore, these are the revenues. Now we need to deduct the cost of goods sold. Of course, the cost of goods sold is the beginning inventory plus the cost of goods or the cost of goods manufactured or the production costs minus the ending inventory. But of course, we do not have any beginning inventories. Therefore, the cost of goods sold would be the production costs minus the ending inventory. Of course, the production costs here would be the costs that were allocated from the $400,000. Therefore, for the cream, it would be 100,000. For the liquid skim, it would be 300,000. Now we need to deduct the ending inventory. Of course, we have in the ending inventory 5,000 gallons for the cream and 45,000 gallons for the liquid skim, and we would multiply them by the cost per gallon that have been calculated in the first step. Therefore, the cost of goods sold, as we can see here, is 80,000 and 120,000. And after that, of course, deducting the cost of goods sold from the revenues would give us the gross margin. As we can see here, $80,000 is the gross margin for the cream, and for the liquid skim is $0. Therefore, the gross margin percentage or ratio is 50% for the cream and 0% for the liquid skim. This is the second method in order to allocate the different costs or the joint costs onto the different products. Any questions? Yes? Therefore, let us now continue with our methods. Let us go back to the market-based methods and see how we are going to use the net realizable value method in order to allocate our joint costs. Sometimes we do not have the sales value immediately after the split-off point as an available data. We do not have available sales value for the products immediately after the split-off point. In this case, we could not use the sales value at the split-off point because, as we said, the sales value at the split-off point uses the sales value immediately after the split-off point. Therefore, if we do not have available information about this sales value or about these sales value, we could not use the first method. Therefore, we are going to implement another method which is called the net realizable value method. According to the net realizable value method, we are going to allocate the costs to joint products on the basis of the net realizable value of the total production again. And we are not talking about the amount that was sold. We are talking about the total production amount that was produced in our joint process. So what do we mean by the NRV? NRV is the final sales value minus the separable costs. Of course, we are going to get the NRV because we are going to process further these costs, or sorry, these products. Why do we need to make this further processing? Because as we said, we do not have data, or we do not have available data on these products about their prices or sales value immediately after the split off point. Therefore, they would be processed further in order to be sold. Correct? And as we said in the last time, that any cost that is incurred after the split off point is called separable costs, not joint costs. Therefore, the net realizable value would be calculated by deducting the separable costs after the split off point from the final sales value, which is the sales value after further processing. Therefore, let us see, or let us take an example of further processing. Here, as we can see, example number 2. Assume the same data as in example 1. That means we have the cream and we have the liquid skim. Except that both cream and liquid skim can be processed further. Now we are going to consider that these amounts will, or these products will be further processed. Cream would be further processed into buttercream. Therefore, the 25,000 gallons of cream are further processed to yield 20,000 gallons of buttercream at additional processing cost of $280,000. This $280,000 is called separable costs. Buttercream, which sells for $25 per gallon, this is the sales value, or the final sales value after further processing, is used in the manufacture of butter-based products. Now we are going to also process further the liquid skim into the condensed milk. According to our example, the 75,000 gallons of liquid skim are further processed to yield 50,000 gallons of condensed milk at additional processing costs of $520,000. These are also the separable costs. Condensed milk sells for $22 per gallon. Of course, the $22 also is this final sales value after the further processing. Sales during May 2012 are 12,000 gallons of buttercream and 45,000 gallons of condensed milk. Of course, this information will be used only to prepare the income statement, not to allocate the joint cost, because we said we are going to allocate the joint cost according to the gallons, or according to the quantity that has been produced, not sold. Therefore, let us see again, or the additional information, or the additional illustration. As we can see here, we could illustrate the words within the problem into a graph. Of course, as we said, this is the first part, which was example number 1. We had 110,000 gallons of raw milk that was processed into cream and liquid skim. Now we are going to incur separable costs on the cream itself and on the liquid skim itself also, in order to change the cream into buttercream and the liquid skim onto the condensed milk. Therefore, we are going to incur 280,000, which is separable cost, and 520,000, which are separable costs, in order to make this further processing. Of course, here is the data. Of course, as we can see here, the joint costs are the same, $400,000. the separable cost did not have any effect, did not have any impact on our $400,000 because the joint cost or the separable cost would not interfere with the joint cost that has been incurred in the joint process. Of course, we have 0 as the beginning inventory. We have the production, 20,000 and 50,000 for the condensed milk and the buttercream. And of course, we have the sales, the 12,000 and the 45,000. And the ending inventory would be, of course, 8,000 and 5,000, which is 20 minus 12 and 50 minus 45. And the sales value is 25 and 22 as given in our example. Now, let us see how we are going to allocate the $400,000 using the NRV method. Therefore, first of all, we need to calculate the NRV for the different products. So how we are going to calculate the NRV for the different products? We are going to deduct the separable cost for each product from the final sales value of each product. Therefore, after achieving or calculating the NRV value, we would use the NRV value for each product to get the percentages of this NRV from the total NRV of the total production that we produced after the further processing. Therefore, as we can see here, the final sales value is 20,000 gallons of buttercream multiplied by the sales value or the final sales value, which is $25 per gallon. While as for the condensed milk, we would multiply the 50,000 gallons, which is the total amount produced, by the $22, which is the sales value or the final sales value for this product. Of course, as we can see here, 500,000, 1,100,000. The total amount would be 1,600,000. Of course, this is the final sales value. Now we need to deduct the separable costs. Of course, the separable costs were given directly in the example, to 180,000 for the buttercream and 520,000 for the condensed milk, with a total of 800,000. Therefore, in order now to achieve or calculate the NRV, we need to deduct the final sales value from the separable cost. Therefore, we would have 220,000 for the buttercream and 580,000 for the condensed milk. Now, we need to use this or these values of the NRV in order to calculate the different percentages of the different products. Therefore, we would divide the 220,000 by 800,000, and we would divide the 580,000 by 800,000 in order to achieve or in order to calculate the percentages of the different products that we have. Of course, as we can see here, the first would have a 27.5% and the second would have a 72.5%. What does this or what does these percentages mean? It means that 27.5% of the total net realizable value of the total production is contributed by the buttercream, and 72.5% is contributed by the condensed milk. Now we are going to use these percentages that are calculated in order to allocate our joint cost. Therefore, we would multiply the $400,000 by these different percentages. Therefore, 400,000 multiplied by 27.5, it would give us or would yield 110,000. While as multiplying the 400,000 by the 72.5% would yield or would contribute or would allocate the amount of $290,000 as the cost for the condensed milk. Of course, adding the two up will most definitely equal the 400,000. If we have another number, or the addition of these two numbers achieved or yielded another number than the 400,000, that means that we have a problem in our allocation process. We need to go back and see what the problem was. Of course, if I now understand that the 110,000 is the allocated joint costs, and the 290,000 is the allocated joint cost for for these two different products simultaneously, what do you think is the production cost? Is it the same as these costs? In the sales value, method, or the sales value at the split off point method, we said that the joint costs are the production costs, correct? In this case, would the allocated joint costs be also the production costs? What do you think? Why no?
Because we will add the separable cost.
Excellent, excellent. Because the joint costs are only a portion of production costs. Because according to this example, we did not only incur the joint cost, but we also incurred the separable cost. Therefore, the production cost would be the allocated joint costs plus the separable costs. Therefore, in order to calculate the production cost per gallon, we need to consider the 110,000 plus the 280,000 divided by the number of gallons, which is 20,000 gallons. While as for the condensed milk, also we need to consider the allocated joint cost by the amount of 290,000 plus the 520,000, which is the separable cost in order to process further the liquid skim into the condensed milk, and divided by 50,000 gallons, which is the total production for this type of product. Therefore, 110 plus 280 divided by 20,000 gallons would yield, or would be $19.5, which is the cost per gallon. While as 290 plus 520 divided by 50,000 gallons would yield $16.2, which is the cost per gallon for this product or the condensed milk. Any questions? Therefore, as we can see here, it is simple. There is not a lot of complication in the computation or the allocation of these joint costs, but we need to understand, or we need to be careful to use the total production amounts in the allocation process, not the amount that was sold within a specific period. Now let us go to the income statement. Of course, we are going to start with our revenues. According to our example, they gave us that 12,000 gallons was sold from the buttercream and 45,000 gallons was sold from the condensed milk. Now, of course, in order to get our revenues, we are going to multiply the quantity sold by the sales value or the selling price. Therefore, we would multiply it by $25 and $22 simultaneously, and we are going to get these revenues as indicated. And of course, now from the revenues, we are going to deduct the cost of goods sold. We are going to deduct the production costs. Now, the production costs are two different costs: the joints, or the allocated joint costs, plus the separable costs for each of these different products. Therefore, the production costs here are the joint costs, which was allocated by the amount of 110,000 for the first and 290 for the second. And then we are going to add the separable cost by the amount of 280 for the first and 520 for the second. Adding these two up would yield 390,000 and 810,000. Of course, these amounts are the production costs. But because we have an ending inventory, which means that we did not sell all the amount that has been produced, therefore we need to deduct the amount of, or the cost of the ending inventory. Therefore, in order to calculate the cost of the ending inventory, we would multiply the number of gallons that are at hand at the end of the period by the costs that were calculated in step number 1. Therefore, the ending inventory for the first is 8,000 gallons multiplied by the cost per gallon, which is 19.5. While as 5,000 gallons were at hand at the end of the period for the second product, multiplied, of course, with the cost that has been calculated before, 16.2, would yield for us the ending inventory, or the cost of the ending inventory. Now, the production cost deducting from it the ending inventory would yield for us the cost of goods sold. Of course, deducting the cost of goods sold from the revenues would yield for us the gross margin. As we can see here, the gross profit here is 66,261, with the gross margin percentages as follows: 22% and 26.4%. Any questions? Therefore, this would be the second method in our market-based category. Now we only have one method more, which is the constant gross margin percentage NRV method. Of course, in this method, we are going to allocate our joint costs under the assumption that each of the joint products would have the same gross margin percentage. Hence the name constant gross margin NRV method. Therefore, now we are going to calculate, or we are going to allocate the joint costs according to this method, using the assumption or under the assumption that the first product, which is the buttercream, would yield the same gross margin as the buttercream. Of course, this is an assumption, and as we took before, this is a wide assumption that is, let us say, hard to be available in real life. But this is one of the methods that we are going to consider. Therefore, if we need to use this method, we need to start from the bottom and then we are going to start from the last step to the first step. Of course, according to our sales value method or according to our NRV method, first of all, we allocated the joint cost and then we calculated the cost of goods sold in order to calculate the gross margin, correct? Now, in this method, we are going to start from the bottom to up. Therefore, we are going to start by, first of all, calculating the constant or calculating the gross margin. And from the gross margin, we are going to calculate the production costs. And then, from the production costs, we would calculate the joint costs that are allocated onto the different products. Of course, the flow of the sales value method or at the split off point, of course, and the NRV method considered the following steps. First of all, in step number 1, we allocated the joint costs, correct? Step number 2, we calculated the production costs, and of course the cost of goods sold. In step number 3, we calculated the gross margin. Now we are going to use the opposite steps or the opposite flow. We are going to start with step number 3 and then with step number 2 and then with step number 1. Therefore, the first would be for us to calculate the gross margin. How we are going to calculate the gross margin? We need now to consider that the total gross margin of total production would be the same gross margin for the first product and the second product. Therefore, in step number 1, we need to calculate the final sales value. Of course, the final sales value is the production quantity multiplied by the selling price, which would yield 1,600,000 for the total production. We are talking here for the total production, minus the joint and separable costs all together. Therefore, as we can see here, we are considering the production of 2 products as only 1 product. Therefore, the separable costs are 280 and 520, and the joint cost is the 400,000. Therefore, the total production costs are 1,200,000. Now, deducting the final sales value from the total production cost would yield us $400,000. What is the $400,000? This is the gross margin. Therefore, can we now calculate the gross margin percentage? Of course. Dividing the 400,000 by 1,600,000 would give us, or would yield, the 25%, which is the gross margin percentage. Now, after calculating the gross margin percentage, we are going to assume that this percentage is the percentage, or the gross margin percentage, for the first product as well as the second product, which is a broad averaging method, because we are considering here that the cost to sales relationship values are the same for the different products, which is sometimes not correct. But this is the assumption that we are going to use in this method. Now, step number two. Step number two, we are going to calculate the production costs. How we are going to calculate the production costs? For each of the different products, I know the gross margin percentage and I know the sales value. Therefore, of course, the main process, or the main calculation steps are dividing the sales, or deducting the production cost from the sales value would give us the gross margin, correct? But if we have the gross margin and we have the sales and we do not have the production cost, of course we can deduct the gross margin from the sales in order to get the production cost, which is the same which is the method that we are going to use in this case. Therefore, the final sales value for the first product, of course, as we calculated it before, 500,000, and for the second product is 1,100,000. These are the sales value for the total production. Again, for the total production, not the amount sold for a specific period. Now, deducting the gross margin from the sales value would give us the production costs. But how to get the gross margin as an amount? Of course, we have the gross margin as a percentage. Therefore, we would multiply the gross margin percentage by the sales value. We would calculate by this the gross margin for each product independently, correct? Therefore, 25% multiplied by 500,000 is 125. 25% multiplied by 1,100,000 would yield 275,000, which is the gross margin for the second, and 125 the gross margin for the first. Now, after knowing the sales amount, after knowing the gross margin amount, we can deduct these two numbers in order to get the production cost, or the total production cost. Therefore, 500,000 minus 125 would yield 375, which is the total production costs. While as 1,100,000 minus 275 is 825, which is the total production cost. Therefore, according to step number 2 here, we calculated the production costs. Now, we all know that production costs consists of two different costs, correct? Therefore, this production cost that has been calculated consists of two things, or two categories. First of all, the allocated joint costs and the separable costs. If I know the production cost and I know the separable cost, Can I calculate the joint costs? Of course. Therefore, deducting from the total production cost, the separable cost would give us the allocated joint costs. Therefore, 375,000 minus 280,000 would yield 95,000, which is the allocated joint costs onto the butter cream product. While as 825,000 minus the separable cost of 520,000 would yield $305,000, which is the allocated joint costs onto the condensed milk. Of course, adding these two up would most definitely yield or result in the amount of $400,000, because adding these two amounts up would give us the joint costs that were incurred before the allocation. Any questions? Therefore, as we can see here, we started with step number 3 and moved the way or moved up until step number 1. Now let us present the income statement. Of course, the income statement would start with the revenues. As we can see, we need to deduct now the cost of goods sold. Of course, the cost of goods sold would be the production costs minus the ending inventory. Of course, we do not have the beginning inventory. That's why we did not consider the beginning inventory. Of course, if we have the beginning inventory or we have a value of beginning inventory, it needs to be considered. Therefore, the production cost would be the joint cost plus the separable cost. Of course, the joint costs were allocated according to our 3 steps, 95,000 and 305,000, and the separable costs were presented in the example itself, 280,000, 520,000. Therefore, as we can see here, 375,000, 825,000, which is the same production cost that were calculated in step number 2, as we can see. Correct? Now, deducting the ending inventory, of course, deducting the ending inventory would be by multiplying the number of gallons at hand at the end of the period by the costs of production per gallon. How we are going to calculate the cost of production per gallon? Yes, of course, 280,000 plus the 95,000, which is the 375,000, divided by the total number of gallons produced, and the 825,000 divided by the total number of gallons produced from the condensed milk. Therefore, the costs would be as follows: $18.75 per gallon and $16.5 per gallon simultaneously for the 2 different products. Now, the cost of goods sold are calculated. The revenues minus the cost of goods sold will give us the gross margin. And of course, as we can see here, the gross margin percentage would most definitely equal 25%, which is the same percentage that was calculated in step number 1. Of course, as we said, this method will always yield or will always result in the same gross margin for the different products. As we can see here, the 25% is for the first product as well as the second product. Why? Because as we said, our assumption here is that the total gross margin for the total production would be the same gross margin for the first product, the second product, the third product, the 10th product, and so on. Any questions? Of course, these are the different methods that are used in order to allocate the joint costs. Now let us get to an important discussion point. What is the best method to be used in order to allocate joint costs. What do you think? This is the most important point in the whole chapter. We took the different methods. We understood the different methods and how to achieve and use the different methods. But now let us consider the decision of management on how or what is the best method to be used. So what do you think? Yes.
The best method will maybe will be sales value at split point because it's a simple method and we don't have information of sales value after split point.
Excellent, excellent. Therefore, the best method to be used is the sales value after the split off point. This is, or this would be, the best method to be used. Why? Of course, we said in Cost Accounting 1 that we need to allocate costs either by using a cause and effect relationship or benefits received relationship between the allocation basis or the allocation base that we are going to use and the cost itself. Therefore, the cost driver should be, or the cost driver should have a cause and effect relationship with the, let us say, or the allocation base better than the cost driver. The allocation base should have a cause and effect relationship with the cost itself, or it should have a benefits received relationship. Therefore, the costs should be allocated either by the first or the second. Of course, as we can see here from our joint process, we do not have a cause and effect relationship. Why do you think we do not have this cause and effect relationship? Yes. Consider the following. We have a joint process that will yield product A and will yield product B. And this is the joint cost. We need to allocate the joint cost onto product A and product B. Therefore, we will consider, as we took in Cost Accounting 1, in order to allocate these costs, we need to find this cause and effect relationship. We need to find an allocation base that has a cause and effect relationship between the cost here, which is the joint cost, and product A, as well as the joint cost and product B. As we can see here, the cause and effect relationship is not applicable in this case because the joint costs caused the production of product A as well as product B. Excellent. Therefore, we would not have a cause and effect relationship for product A that is different than product B, correct? Therefore, how we are going to allocate if we have the same and the same cause and effect relationship, if we have the same allocation base? Therefore, the cause and effect relationship that we talked about in Cost Accounting 1 and we talked about in Cost Accounting 2 in the activity-based costing and so on could not be achieved or could not be used in this case, because as we said, this joint costs does not have a cause and effect relationship with the first product that is different than the second product. Why? Because these joint costs that were incurred affected or caused the production of these two products simultaneously. Therefore, we need to consider now the second perspective, which is the benefits received. That means we need to calculate, or we need to allocate the joint costs onto the first product and onto the second product according to the benefits that are received from product A separately and from product B separately. This is why the best method to be used is the market-based category. Because as we all know, the market-based category considers the sales value, whether it is the sales value after or immediately after the split-off point, or whether it is the sales value after the further processing. But we are considering the sales value. What do you mean by the sales value? Isn't it the benefit that we are receiving? Yes, indeed. It is the benefit that we are receiving from the production of these different products. Correct? Therefore, the first category, which is the market-based category, would consider the benefits received as the allocation base, or as the method by which we are going to allocate these costs. Of course, the physical measure, on the other hand, does not consider the same criterion, does not consider the same perspective. Why? Because in the physical method, we are going to allocate the costs not according to the benefits, but according to the physical measures. Correct? Now I need to ask you this question. Does the physical measure indicates the benefit, or does it indicate the benefit? What do you think? If, for instance, we had in product A, for instance, we achieved 1,000 kilograms, and here we achieved 500 kilograms. So does this mean that the benefit of the first product is larger than the benefit of the second product? Therefore, the physical measure does not indicate the benefit. Correct? Let us make it more simple. What if product A is iron and product B is gold? According to the physical measure, we are going to allocate more costs on product A. Why? Because it has the larger amount of the physical attribute, while as product B has the less amount of the physical attribute, or the amount of kilograms, therefore it would be allocated less. While as, according to our benefits received, it is quite the opposite. We should allocate more on product B because it would have more benefits than the 1,000 kilograms of the product A, which is iron. Correct? Therefore, the physical measure does not consider this criterion of benefits received. Therefore, the best method, or the better method, is to use the market-based methods, and we are going, of course, to complete with our analysis or with our discussion in this point, because this is a very important point, inshallah, the next time, because we are out of time now. Thank you for listening, and I'll see you, inshallah, the next time.